I'm Mark Reynolds from Jones and Roth CPAs, and thank you for. And I am a partner here at Jones and Roth, and my focus is on retirement plan services, and I help oversee this department or area of the firm, and we help organizations set up retirement plans, and we help them administer them, and just overall just provide them information about how they can serve their employees better in providing retirement plan benefits. So. All right, so I'm going to go ahead and start the slides of the presentation. All right, so I want to go ahead and just give us a quick overview of exactly what we'll be talking about today. We're going to go through just payroll deferrals, what they are, how they work as far as a retirement plan. And we'll talk about the SEP IRA, what that is and how that works. And then as we're going to go through here, we are going to talk about 401k plans, 403b plans, two different variations of plans, what Oregon Saves is, and how that works, and then a quick overview of some of the most common instances of the Secure Act 2.0, which actually just went into law just recently over the past year. And then lastly, we'll finish it off with just some plan tools that we have, just some charts and some limit flyers and things, just to provide you some just general information that you'll be able to just take with you also. All right. All right, so retirement plans, really it's a way to provide or help your employees save for retirement. That's just in a nutshell exactly what it is. It's a tool to help provide a meaningful benefit to your employees, help provide incentive, and also help provide for retention. We all are competing for good employees out there, and if you're able to provide something that differentiates you in the benefit space, it's really important to offer what you can to retain and keep those employees, because we're all out there and we're all trying to compete for those employees. Another great reason to have a benefit plan is to be thinking about what exactly are your employees doing for retirement. There was a study that was done by Capital One just recently in 2021, so it's a little bit dated, but I think it's probably still relevant. 70% of Americans are not concerned enough for retirement. That's a lot. That's a lot of Americans out there that aren't really thinking about retirement and retirement benefits. And then also, as part of the study, they found that the average savings for those getting close to retirement are only $12,000, which is not a lot of money. And we know that with rising costs for health benefits, insurance, and just cost of living itself, $12,000 really isn't going to take you very far. So having a retirement plan in place to help those employees save for the future and save for themselves and for their family is a great benefit to them, and help getting them on their way to saving for retirement. All right. So first of all, we're going to kick it off here with exactly, well, how does it work for employees? Well, for the most part, a retirement plan, we'll talk about a few different variations here, but they're going to be deferring parts of their wages to part of their wages into a retirement plan that's set up for them. Yeah, so what a deferral is, it's really just taking a percentage of your pay or a flat dollar amount every pay period and putting it into an account that's set up just for the employees. And so there's done of one of two ways when they do this as part of the retirement plan, is that if it's a pre-tax benefit, it's going to be prior to pre-tax benefit will be subject to any FICA, FUTA, LTD, or other payroll taxes, but it's not subject to federal or state taxes or state transit taxes too. So pre-tax is pre-federal and state taxes, but after you'd be paying any federal tax withholdings on those dollars. An after-tax contribution going into a plan is just that. It's after you've paid all of your federal and state taxes, all your payroll taxes in the pre-tax category, but it's a flat dollar amount or percentage of your pay that goes into your account after you've paid all of those taxes on those contributions. So I equate a Roth contribution or after-tax contribution to paying taxes on the seed of today, but not the fruit of tomorrow. So depending on if you have young employees who aren't, they're new in their career, they're a lower tax bracket, and they're not really concerned about trying to save taxes on contributions today, a Roth contribution can be a really great option for those employees who aren't really paying a lot in taxes today. So you might as well just pay a little bit today and never pay taxes on it ever again. So that a Roth can be a great choice for them. When amounts for a retirement plan are withheld from an employee's paycheck, they are transferred to an investment account that's set up for them as soon as it is administratively feasible to get those dollars transferred to whatever investment company or investment account that is set up for that employee. And generally it needs to be done within 5 business days. Any employer contributions that are done into a plan, this is in general sense here, are always going to be pre-tax and they're deductible by the employer. So they're not taxable to the employee when they receive that benefit, but they are going to be taxable on the back end when they actually take those dollars out at retirement. And so anything the employer puts in plus earnings when the employee takes it out on the back end would be subject to income tax when they take it out on the back end only. All right, so the first type of plan that we're going to talk about here is the SEP IRA, also known as a simplified employee pension. This is probably one of the simplest forms of retirement plans that are out there. It is an employer-only contribution type of plan, and so employees aren't allowed to put any money in there, just the employers. And the maximum amount that an employee, or excuse me, the employer puts in on their behalf can be up to 25% of compensation, up to a maximum dollar amount of $66,000 a year. And the max compensation per employee is pretty high. It's limited up at $330,000 a year. And so basically 25% of compensation is the max the employer can put in for the employee on their behalf. A benefit of a SEP IRA is that the employer can establish a plan up to the return filing date, including extensions. And this would be count for either for-profit business returns or for 990s or whatever filing you're required to do. And then all contributions that do go into the plan, again, are pre-tax dollars that go in. So they're going to be taxable to the employee on the back end, plus any earnings when they take those out at the time of distribution when they get to retirement age. Next form we have is called a simple IRA, and what simple stands for is a savings incentive match plan for employees. So simplify it, just call it a simple IRA. A simple IRA has 2 components to it. The first part is the employee putting money in out of their own paycheck through payroll withholdings, and the other portion is an employer contribution, and there are 2 forms to that. The employee is allowed to put in for 2023 up to $15,500 a year, and that's either as a percentage of their pay or a flat dollar amount. They just can't exceed in total that $15,500 a year. And if an employee is over age 50, or actually age 50 and over, they are allowed to put in an extra $3,500 a year, known as a catch-up contribution. And so really, if you're age 50 or over, you can put in up to $19,000 a year. So one of the caveats to a simple IRA is that the employer does have a required contribution that must be put into the plan. So they have 2 choices of that. The first one is a match, and the second one is a flat contribution. The match contribution is a 3% match. So basically you would match 100% of the first 3% that an employee contributes into the plan. That's option A. Option B is a 2% flat contribution to everyone who is eligible to participate in the plan. So one of the questions I often get from employers is like, well, why would I want to do one or the other? And so probably the most common reason why an employer picks the match is that an employer wants to have employees have some skin in the game. They want them to participate and make some contributions. And so if you're willing to contribute to your retirement and to your future, hey, we're willing to match that and put some dollars in for you also on your behalf. So that's probably the main differentiator why you would choose one or the other. Some employers though just choose, no, it's easiest, so we're just going to do 2% contribution to everybody who's eligible, whether they participate or not. And that's certainly a viable option too. So you have to kind of do what works best for you and for your organization and kind of what your objectives are. Because each of these are required contributions, one of those two that you have to do every year, you could run into a circumstance where you may have a financial hardship for the organization in a certain year. And so there are some safe harbor provisions within this plan to reduce the amounts of contribution that you would that you'd be required to do within any 5-year period. So you can do a lesser match from 1 to 3% of compensation allowed within allowed for 2 years within a 5-year period. So there is some relief out there if you run into a circumstance where, like, a certain year you're not able to do the contribution, or you could do a lesser contribution. The IRS does have some provisions in there for you to provide some relief to you. Excuse me. All right. So contributions that go into a simple IRA are always going to be pre-tax, so they're taxable on the back end. A simple IRA is really meant for small employers. So the company cannot have any more than 100 employees. And so if you're going to cross over that 100 employee mark, a simple IRA wouldn't be a plan for you. You would need to step up to a 401k or 403b plan, which would be the next level up. From an eligibility perspective, you do have some flexibility in who participates in the plan and at what point in time. But the most stringent that the IRS requires is income of at least $5,000 or wages over $5,000 in any 2 prior years, and expect to have at least $5,000 of wages in the current year to be eligible to participate. That's the most stringent the IRS says you can make it. However, you can certainly make it less stringent. We have some employers who, decide we're not going to have any prior year requirements, and as long as you make $500 in the current year, you're eligible. So you can make it as lenient as you want. You just can't make it more stringent than that $5,000 threshold. So that's the most stringent that I can actually be. If you're going to establish a plan in the current year, there is an October 1st deadline. And so today we're at July 24th. And so if you're going to set up a new simple IRA plan for your organization, it would need to be fully set up by October 1st, 2023. And that means having the adoption agreement completed. And the IRS has a simple adoption agreement, which is, I think it's like 2 pages. It's on their IRS website. Then you would also have to have your investment company set up wherever the funds are going to go to, whatever investment company you're going to use for the employees. That would need to be set up. And the enrollment meetings that you would need to have would need to be conducted before that date. And it really just needs to be totally up and going by October 1st. And so if you're thinking about trying to do a 2023 plan, really you would need to probably get on it now and get it going so you could meet that October 1st deadline. If for some reason you didn't meet the October 1st deadline, it's not the end of the world. The plan would just be effective as of 1/1 the following year. And so if you didn't meet the October 1st, January 1st of 2024 would be the next eligible date that you could have a plan set up. But you'd have it set up and ready to go as of the first of the year. All right, so we're going to talk about 401k plans. And once we go through some 401k types of plans and provisions, we're going to talk about some 403b plans also. But for the most part, big picture, 401k plans, 403b plans operate the same way. There are a few differences which we'll talk about, but if I'm referring to 401k plans here, just think about 403b plans. It's generally going to be the same types of provisions unless we designate it or tell you about anything that's different. So kind of keep that in mind as we go through this. So 401k plans are more complex, or 403b plans, than the SEP IRA and the simple IRA. However, being more complex does give us a lot more higher thresholds in contributions. It does give us more flexibility and eligibility, and it does give you more options of how you make contributions on behalf of employees. And so while it does potentially come with some additional costs that you may not have with those other types, just be thinking about, as your organization grows, you want to be able to have flexibility in the way you provide benefits to your employees, and these types of plans will help provide some of those benefits, and sometimes a better or more efficient way. So in the 401k, The maximum deferral limit for 2023 is $22,500. And then the plans also allow for an additional catch-up contribution of $7,500. So if you have an employee who's age 50 and over, they can actually put in up to $30,000 a year into the plan on behalf of themselves. And so it's definitely a significant higher threshold than we're talking about as far as the SEP or the simple plans. So those contributions can go in on a pre-tax or after-tax basis. And so again, pre-tax before any federal or state taxes, but after payroll taxes, and then Roth again after you've paid federal and state taxes and payroll taxes can go in. And so again, great variation of that. And it allows you to do those two different contribution types for simple, again, all pre-tax only. Here you get a choice. The employee has a choice of how they make those contributions. The maximum allocation of employer contributions and employee deferrals into the plan for a single participant is $66,000 a year. And so basically, when we talk about max allocation, this is just the max amount of dollars that can go in from all the sources between employee and employer has a limit of $66,000. So it's a pretty high limit as far as how much between employer and employee contributions that can go in. And again, for the 401k, employer contributions are always going to be pre-tax, just like the other contribution types for the employer contributions for the other plan types also. A great benefit of the 401k plan is the method of discretionary contributions. You have a lot of choice in how you put dollars in and how you determine those contributions. And it really depends on what works best for you and your organization. You can put in a flat dollar amount per year. So in this example, the organization has $50,000 that they can allocate to employee contributions. You can just put in $50,000 and it just gets allocated to everybody based on eligible wages. That's one method. Or you can say we're going to do a profit sharing that's equal to 3% of everybody's compensation who's eligible, and you can just do that. And so it's gives you flexibility. Another way is to do match, similar to some of the other plan types, but a discretionary match really gives you, again, flexibility in the way the money goes in, but also encourages employees to participate on their own. A typical match you'd see is a 3% match. Often it's 50% of the first 6% that employees put in. That way, if they put in 6%, a little higher contribution number, they're going to get a 3% match. Or you could just say we're going to match 100% of the first 3% or 2% or whatever works for you. But there's a lot of flexibility there in the way those contributions or matches are determined and what works best for you and your employee group. Excuse me there, I need a little bit of coffee to keep going. Okay. All right, so another variation of the 401k that we always want to make sure that organizations are aware of is having potentially some type of safe harbor plan set up or safe harbor provision within your plan. Because one concern that when you set up a retirement plan is that you have different levels of employees, you have different groups of employees. Typically, you'll have an executive director or a management team that might have higher compensation or pay than your rank and file employees. And so it's important to have provisions in the plan that will ensure that everybody gets to participate in the plan and gets to make their own payroll deferrals into the plan. When an employee has over $150,000 a year of compensation for 2023, there are certain testing requirements that are required for a 401k or 403b plan. And so what the IRS and the Department of Labor wants to look at, what they want to ensure is that there isn't any undue discrimination between employee groups. And so if you have highly compensated individuals contributing the full $22,500 or $30,000 if they're over age 50 into the plan each year, that could be disproportionately higher on percentage of wages than what you would have for rank and file employees. And so, the IRS feels, hey, you know what? People who make more, it's easier for them to put maybe more money into the plan than someone who doesn't. And so they want to ensure that there is not any undue discrimination. And so if you don't have a safe harbor provision within your plan, basically you may fail some of the required testing and those individuals may have to take some of their deferrals that they put in the plan back out. And so if you fail that testing to equalize the required percentages that you're required to have, some of their deferrals, or all of them potentially, may need to come back out of the plan, and they don't really get to participate in the plan. And so having a safe harbor provision in the plan ensures that those individuals will be able to put in the full amount of the deferral piece. And so to get that safe harbor contribution or safe harbor benefit, the organization has to commit upfront to a certain or specific contribution level by the organization. So the organization would need to do either a match of some sort, and the typical match is a 4% match for safe harbor, or they commit to a 3% non-elective contribution, so 3% of eligible compensation for employees. And so you just need to choose one of those two contribution types upfront and commit to that, I guess, in advance. Of course, you're not always going to know exactly how people are going to participate, but if you commit to that 4% match upfront, and anyone who participates is going to get a 4% match if they put in at least 5% into the plan, you've basically guaranteed from the get-go that your highly compensated individuals are able to put in their full amount, and so it provides some assurance to your leaders in the organization that they're going to be able to participate in the plan. And then of course any of your other employees who decide that they want to participate, they're also going to get they're assured of getting a benefit on their behalf also. And so it can be great from a planning perspective, and then but also know that everybody gets to share in the benefits of having this plan in place. One part of having a safe harbor plan, any of the dollars that are contributed by the employer as a safe harbor contribution, those are always 100% vested. So that just means that there are no strings attached to them. There's no service requirement attached to those contributions. As soon as they hit the employee's account, they actually get to take those dollars with them. And so they're always there. It's just like the money that they put in for themselves. All right, so another variation we have of a safe harbor plan is known as a qualified auto enrollment contribution arrangement. And so we call it a QACA for short. But basically, it's just a safe harbor plan that has a little bit twist on the safe harbor provisions. One provision or requirement around a QACA plan is that you must auto enroll your employees as soon as they're eligible. And then that safe harbor contribution that's required can either be a 3% contribution to everybody who's eligible, or the match is a 3.5% match. So if you're willing to do the auto enrollment provision, the IRS says like your maximum match is actually 3.5% instead of 4%. So you get a little bit of a reduction in the required match. And it's calculated, of course, a little bit differently. The IRS always has different ways of doing different things. But basically, you would match 100% of the first 1% the employee puts in, and then 50% of the next 5%, or 3.5%. So you get a little bit lower match percentage. And one of the other benefits of having this type of safe harbor plan for your organization is that there's a 2-year cliff vesting on that safe harbor contribution. And so an employee has to work for you for 2 years to be able to retain that benefit that they've received under this plan. And so it has some strings attached to it to keep those good employees there for a longer period of time. So you got to be there for 2 years or have 2 years of service to retain that safe harbor contribution that you received. And so a lot of employers like having this version of the safe harbor plan because it doesn't make, as soon as those dollars go directly into the plan and the employee leaves, they don't just take it with them. And so it provides a little bit more of a retention benefit to the organization. One other item down here in bold here at the bottom is that auto enrollment is a big thing with the different versions of the Secure Act that have recently come out. Basically, plans starting in 2023 and going forward, brand new plans are required to have auto enrollment. So if you're required to have that anyways, maybe look at a different variation or flavor of that might be good for your organization. All right, so a few other things here on the 401k side. From an eligibility standpoint, there's really a lot of flexibility here. You can choose to not have any eligibility requirements or have a number of eligibility requirements. It really depends on what's best for you. But the most stringent eligibility requirements are age 21, 1 year of service, and semi-annual entrance dates. And so basically what that would mean is once someone has worked for you for 12 months and they've worked, typically it's 1,000 hours in that year, they enter the plan the following January 1st or July 1st. And so depending on when an employee is hired, they could potentially be out of the plan or not eligible to participate for almost 18 months. And so if you're have an organization that has a high amount of turnover and you want this benefit really to be for your long-term employees, that may be a good option for you. Well, we have other organizations that really want to get people in there as soon as they're eligible to participate and push that up a lot, where it could be the first day of the following month to participate. You could also have different eligibility for deferrals out of paychecks for employees, but also for employer contributions too. So you can actually have some different eligibility dates if you want to have that. A benefit also is that you can have a vesting schedule on any employer dollars that go in that are not safe harbor dollars. So any profit sharing or matches that aren't safe harbor dollars, you can have a vesting schedule attached to it, out to 6 years. You can allow for participant loans, so employees could borrow against their balance, and then also you can allow for hardship distributions also. So it gives employees a method or mechanism to have access to some of those dollars in case they need it for any hardship circumstances. And then also just know here that the Secure Act, which recently went into effect and allows for plans to be started after year end for tax or for employer contributions only. And so there's more flexibility now with the Secure Act as far as setting up new plans and the timing of that, if you're going to do just employer contributions for that year. Of course, the following year, you'd be eligible to do employee and employer. So just a little caveat there. All right. So now we're going to touch on 403B plans. And so some of the differences we have between 401ks and 403Bs are 403Bs primarily are designed for nonprofits. However, probably, I don't know, 15, 20 years ago, some of the laws and rules changed around what types of organizations can have what types of plans. Now, nonprofits can all have 401k plans. So you can have 401ks or 403Bs. So the choice is really up to you. You're never going to have a for-profit business with a 403B, but a nonprofit really can choose between the two. One provision that's unique about 403B plans is universal eligibility. So participation of employment commencement dates. Typically you're going to have more employees eligible sooner in a 403B than you would in a 401k. But you do have some options as far as some other provisions. Employees less than 20 hours a week, you're allowed to exclude. You can exclude professors on sabbatical if you're an education institution, certain types of students, union employees, and then non-resident aliens with no U.S. income can also be excluded from 403B plans. Again, from a contribution perspective, the limits are the same as the 401ks. For 2023, we still have the $22,500. If you're under age 50 and over, another $7,500 or $30,000. And then the maximum amount that can go in for any individual is $66,000 if you're under 50, and then 50 and over is up to $73,500. So I got those higher limits there in 403B plans too. Another unique provision in a 403B plan, which you don't get in a 401k, is this 15-year rule. It's a 15-year catch-up rule. So you may have some long-term employees who've been there for a long time, and maybe they haven't, participated or put a lot of money away in their retirement, but now they are closer to retirement and they're maybe in a position to do that. And so there's actually some provisions to allow them to put in a little bit higher catch-up contribution than you would be able to do otherwise in a 401k. So the additional amount is that allowed is the lesser of $3,000 or $15,000 reduced by the amount of the additional elective deferrals made in prior years, or 5 times the number of employees service in the organization less elective deferrals. And so basically a lifetime limit of $15,000 of extra contributions. And so there's a long calculation that goes to that. So if you have anybody in that situation, you just need to look at it closely with your third-party administrator or the accountant that you're working with to help determine to make sure that, in fact, that individual is eligible to do that. So it's a little bit of a convoluted calculation, but it can be a great benefit to someone who might be in that situation. All right. And so some of the things to be thinking about when you're talking about 403B plans, it's like the plans, we need to determine whether or not you are in ERISA or non-ERISA plan. And so basically what that means is that, are you under the federal rules and guidelines for the Department of Labor and the IRS or not? And so that can be a question that's always out there when you do have a 403B plan. So plans sponsored by a governmental or public education institution, they're exempt from ERISA, so these federal rules. Plans sponsored by religious organizations are also going to be exempt, and then private sector non-governmental 403B plans established by a nonprofit 501c3 and tax-exempt organizations that meet certain requirements may be exempt from ERISA. It's important to note that you're not automatically exempt from it, and so you have to hit certain provisions to be exempt from ERISA. And to be honest, from what I know, there really aren't that many plans that are out there anymore that are exempt from ERISA. I think it's important to just have this in here so that you're aware of them, and also that you may have a grandfather or older plan that is not subject to ERISA, but I'm not even aware of any new 403B plans putting into place that are exempt, because most vendors or providers don't want to do it because there's risk of it not being done properly. So, but we'll go over what these are just in case this is something that may affect you. So for non-ERISA, there are some of these Department of Labor safe harbor rules around them. Basically, employees are participating in the plan on a voluntary basis. All rights are under an annuity contract or custodial account agreements, and it's only enforceable by the employee and their beneficiaries, not the company. The company doesn't have anything to do with that. And there are no company contributions that are going into the plan, and the employer has very limited enrollment involved in the plan. Also, the employer doesn't receive any compensation other than reasonable amounts to cover expenses. So again, very limited involvement by the employer or by the organization. You may be just depositing contributions. You're going to allow a vendor to come in and explain their products and provide investment choices, but you're not processing distributions. You're not approving any hardship or loan requests. And then you may review quadros or qualified domestic relations orders. So you're not doing that. And then you're not authorizing TPA or third-party administration services or any in-plan transfers. And so you're really not in a fiduciary capacity in any way, and you're not helping provide those services necessarily to the employee. And so again, we don't see too many of these anymore, but they are out there. So on the flip side, there is a benefit if you're in this category and you have a non-ERISA 403B plan. Well, you don't have to file a 5500 return, which is actual informational tax return that gets filed with the Department of Labor and the IRS. So don't have to worry about that. You could have more than 120 eligible participants, and you're not subject to an audit, which can be huge cost savings if you're not required to have that. And then also there were some change in some of the audit requirements after 1/1 of 23 based on participant accounts. And so let's go another change in some of the Department of Labor accounting rules, and so that are out there, just as an aside. All right. So another contribution or plan type that's out there, and I'm sure that many of you have probably heard a lot about this over the last, I want to say it's probably 5 years that it's definitely been communicated to employers that it's out there. So Oregon Saves is, it's another mechanism to help encourage employees to save for retirement. And again, just going back to some of the initial stats there I had at the beginning, that you have a lot of employees out there that aren't saving at all. And so there are organizations that can't really afford to have any type of retirement plan. And so employees working at those organizations have less availability to access to retirement, education, and they're not thinking about that. And so by having Oregon Saves in place, it does provide one additional mechanism to get employees saving for retirement. And so as part of the initiation of this plan at the state level, there's been a number of initiatives based on organization size to get employers involved, and now they're past the carrot and now they're to the stick. They were basically any employer down to one employee as of the end of July of this month is required to register and get your employees involved in Oregon Saves. So Oregon Saves, you're required to register on the website, whether that you do or do not have a plan. And if you do have a plan, you have your own maybe 401k, 403b, simple or SEP. You just need to attest that you do have that. And so if you can demonstrate through this document that you complete that, yep, I do have a plan, it's there, then you're exempt from Oregon Saves for a 3-year period. And then every 3 years, you're going to be required to reattest that you are still exempt from participating in Oregon Saves. So basically, Oregon Saves is a requirement for any employer that has employees with Oregon-based wages and you're over age 18. And so no plan in place, Oregon wages, over 18, you're gonna be required to participate in this plan. Okay. So what is it? And so the plan has auto enrollment after 60 days of employment. The initial auto enrollment for your employee into this plan is it's at 5%, and then it has an auto escalation of 1% per year up to 10%. However, employees can opt out. They don't have to participate, but you are required to basically communicate this and get them going, and then they can opt out and not participate. Also, they can put in a different contribution amount. They can put in up to or down to 1%. And so if they want to do a lower contribution amount, they can certainly do that. And then 30 days prior to the auto enroll, there's a notice that actually goes out to the employee and saying, hey, this is going to be starting. We're going to auto enroll you. And then the employee has a chance to opt out if they decide not to participate within the plan. So Oregon Saves really gets down to, I guess if you want to dilute it down to its basics, it's really just a Roth deferral IRA plan is what it is. And so we have after-tax contributions going into an IRA account for the employee. And so you're still subject to all the same Roth IRA contribution rules. It's just really providing a mechanism for employers to get employees to participate and contribute to something. And so that's really all it is, getting them to participate and contribute to a Roth IRA. So if you're under age 50, you can put in up to $6,500 a year. And then age 50 and over, you can put in an additional $1,000 as a catch-up, so up to $7,500 a year into the plan. Again, you're subject to the same Roth IRA contribution limits to anybody else if you were not participating in the Oregon Saves plan, which is 138,000 to 153 is the phase-out period for single filers, tax filers, and then 218 to 228 for joint tax filers. Those are the limits. And so you may be at a company organization that doesn't have a retirement plan, and you're subject to Oregon Saves, but you may have an executive director or someone in management who's not eligible to participate because they make too much. So they can't defer. And so that's something to just be thinking about. So initial contributions, when they are taken out of the employee's paycheck, they're deposited with the Oregon Saves plan, and they go into their capital preservation fund, which is basically a really low risk type of account. And then after 30 days, they get moved into a target date fund based on the age. And it's just a preset portfolio based on the employee's estimated retirement date. So it gets invested in a portfolio for them at that point in time. And I believe there are some other different investment options also once you go on the website, but that's typically where they start you. And then once you were in there, you can change it to something else if you decide to do that within their menu of options. So with Oregon Saves, no contributions from employers are allowed. It's only going to be employee money that goes in. So you can't do any profit sharing or match or anything like that. Benefit is that there's no administration costs. It's separate from the time it takes to process deferrals and contributions and take them out of the employee's paycheck and contribute them into directly into the plan. One of the benefits, especially certainly in the marketing for this, is the transportability of employee accounts. So you go to a different employer, it's with the state, so you can go to a new employer and continue to contribute to your account. The employer is not responsible for notifying employees of auto escalation. It's actually, there's information that comes out from the state where they communicate it, but it's not your responsibility. There's not any fiduciary compliance requirements from the employer for the investments, so that's kind of a benefit there. However, one thing to be thinking about is that failure to timely remit deductions from payroll to Oregon Saves does violate Oregon law, including wage and hour requirements. And so if you're taking money out of employees' paychecks and you're not timely depositing them in the account, there could be fines and penalties assessed. And really that's not any different than any typical 401k plan. Here it's a statute in Oregon law regarding Oregon Saves, but the same, really the rules same apply to any retirement plan. So, but with here, there's a little bit more teeth to it because the state's actually running the plan. All right, let's see here. And Cheryl, are you on? We're gonna have you go through some of the Oregon Saves, or excuse me, the Secure Act 2.0. 1 minute here. See if I have Cheryl. Have her take care of this piece. And I don't. Okay. I can't hear her. I know she's there. 1 second. Technology is great when it works well. Okay. Let's see. Check here. 1 second.
Hello?
Hello. Yes.
Can you hear me? Okay.
Yes,
Sorry
we
about
can hear
that.
you.
I don't
Good.
know. I guess
Okay.
my mic was muted.
All right.
Sorry.
No worries. Okay.
All right. So the Secure Act 2.0, they actually passed the first version, a few years prior, and then they decided to add to it because there were things that they hadn't gotten into the first one. So some of the really nice things are for required minimum distributions, they actually increase the age for those to age 73 because they realize people are working longer, and so it's not as convenient for them to have to start taking minimum distributions, from their retirement plans. They're not ready to start doing that. So they increased that age to age 73. If you turn 72 after the end of 2022, and then it's actually going to go up to age 75. If you turn 73 after 2033, so 10 years from now. But that's really nice because we do have people who say they're not ready to take their required minimum distributions. They're still working. The catch-up limits increased, and so this is kind of mimicking the 403B catch-up limit, where it allows you to do that special contribution to kind of fund your retirement if you haven't done it. And so they're going to allow you to actually make a higher catch-up limit of $10,000. And just to, in case you haven't, funded as much for your retirement as you want to, as you're getting closer to retirement age. So, and all catch-up contributions after 2024 are going to be Roth contributions. So that's a big change because before you could still do pre-tax, but then it's going to be Roth, which is after tax. After tax money is actually great to have in a plan. So if you have a 401k plan, you can have, the Roth deferrals. And it's really nice because once you start that Roth account, then the money, as long as it's been in there 5 years, then that money is totally non-taxable. So the Roth deferrals go in as after tax, and then any of the earnings on that money becomes after tax. So, it's nice because when you're at retirement age, you have some after tax money as well as your pre-tax money that you have from your employees or your employer contributions. So it does, give you that you know, money where you're not going to be paying additional taxes on it, which is really great. And then one of the things that have been talked about for a few years, you may have heard this in the news, has been brought up of, you know, people having to make student loan payments. And so they basically were making a decision between whether or not they were going to defer into their 401k plan or they were going to pay their student loan payments. And so now they passed, the Secure Act passed a provision where the student loan payments can be considered for employer matching contributions. So if you have a plan where you're doing the employer matching contributions, then your employees, and I'm not sure, we haven't really received guidance on how this would all work, but you know, there's going to be a mechanism, obviously, for the employees have to, you know, provide the student loan payment information, and then based on that, then they would be able to get a match contribution in the plan. So that's kind of nice for the people who aren't really able to defer because, you know, they're paying their student loan payments. And then they're also going to allow one-time withdrawal of $1,000 if they, you know, somebody just really needs money. We always want to encourage people to, you know, leave the money in the plan. Obviously, it's for retirement, but you know, things happen. We know things happen, and so if they needed something, if they needed, you know, some money, they could take $1,000 out of the plan, and there's not going to be a penalty or anything.
Okay.
Okay, I don't know if you, I think he's still controlling it, Mark, or am I? I don't know.
I've got it here. Yep.
Okay.
You want me to change, or are you good?
Yeah. Yeah.
Okay. Okay. All right.
Ready.
Okay.
Another big part of the Secure Act is there's companies who have, you know, they might have long-term part-time employees. So, you know, let's say that you have a plan where you require age 21 and 1,000 hours of service to enter the plan. But then you have, you know, employees who work for you all the time. They, you know, they've been working for you, but they just work part-time. So those people have never met the eligibility requirement to enter the plan. Well, the Secure Act added a provision where people who are, you know, have been working for a long time and they work at least 500 hours a year, then they're going to be eligible to enter the plan for the employee deferral purposes. So they're not, you don't have to have them be eligible for employer contributions, but they would be eligible to defer into the plan, which is good because, you know, then they can start saving up some money for their retirement.
Yep.
And then they're allowing an emergency savings plans to be added to 401k plans where they can put in $25,000 or $2,500 as Roth. So it'd be after tax money, but it's going to be in there. So if they did need to take some money out, you know, this is kind of in addition to, you know, their deferral contributions or any employer contributions. It's just for them to be able to use it, you know, as a savings account, essentially, you know, put some money in there, and if they had an emergency, then they could take it out.
Right. Okay, thanks, Cheryl. All right, so we have just a few other just documents here, and these are going to be items that are available on our website also. So there's some useful information on our website, but just a flyer here, some information. This is Jones and Roth branded information here, but just our plan limits flyer, which is just helpful for you if this is something you need to keep track of as far as your benefits of the 2023 contribution limits. So we have that just a flyer in there that has that by category, so if that's helpful to have for you. And then something else that we've developed that is just a useful tool for working with clients and organizations of, you know, retirement plans are complicated and there are lots of different aspects to it, and trying to also decide, well, what is appropriate for my organization? How much can we contribute? What are some of the high level, you know, rules and contribution limits around that? And so we've developed this retirement plan comparison chart that's also available on the Jones and Roth website, but it just kind of takes it down to the bare basics of, you know, what are the most basic plans, which are there on the far left, which are going to be the most restrictive, but they're going to be the lowest cost and the cheapest types of plans. We don't have Oregon Saves on here, but we have all the other basic plan types. So we start out with the the SEP IRA, and then it goes to the simple IRA because it's a little more complicated. It has employee and employer dollars in it. And then we have defined contribution plans, which would be 401ks, different types of safe harbor contributions, and then most complicated and most expensive is going to be a defined benefit type of plan. So this can be just a helpful tool. It's got 2023 contribution limits on there, and so that can be a useful tool for you in your organization to just have if you're something you're thinking about doing. This could be just something helpful, at least for a discussion point of, where do we start when we're talking to our advisors and our providers of, what type of plan makes the most sense for us. So, all right. That's all that we had. I don't see any questions there in the portal, but certainly thank you for spending. Oh, yes.
Mark, did we
Yes.
talk about the startup credits and the starter K plans?
We did not, because I don't think this was mainly relevant to most of these plans, but certainly I didn't mention it. Go for it.
Well, the startup credit would be relevant. If we're putting in a new plan, so the Secure Act did actually, there always have been startup credits for starting a retirement plan, but the Secure Act actually, made them more robust. So it is something that's available to help offset the cost of starting a retirement plan. If you decide to set up a 401k plan, there's a 401k, there's going to be a plan document that has to be written. All qualified retirement plans, have to have a plan document. So it'll help offset the cost of that. And then also just, the expense of the annual administration work that has to be done. It is available for, I believe, the first 3 years. So that's one thing to keep in mind. And then also the Secure Act passed a provision for what's called a starter K plan, and it's similar to the Oregon Saves program, and really it was in response to the state starting these programs. It's just another plan that you could put in that essentially then you're not locked into the investments that are available. You're not locked into only those investments that are available under the Oregon Saves plan, and then it also allows the employees to start, they just are going to be able to have, I think, a little bit higher contributions. They haven't finalized that yet. They want the contributions to be at least the same as the, like the IRA limits, but it is going to allow you to have the plan somewhere else and have different investments in the plan other than what the Oregon Saves has. We're just waiting on more information for that, though, really.
Yeah. Thanks for bringing that up. Both of those. That was good. All right. Anything else that you think maybe we didn't cover that you need to add on?
I think that's it.
Okay. All right. Again, thank you for attending today, and please let us know if you do have any questions. I'd be happy to follow up after we're done here. Should something come up, and either plan design questions or is a certain type of plan maybe relevant for us and our organization, we'd be happy to talk to you and just make sure you have the best information available so you can make good decisions and do what's best for you and your employees. So again, thank you for coming today, and we'll let you go. Thank you.
Yes, thank you.